the first, port of call for India is through the currency route. We saw it in 2013. We probably saw it about 45 days ago, and we seem to have kind of, escaped barely from a tougher situation that we saw in 2013. But in the last 45 days, I think we've seen two big positives play out for India. Probably 30 days. One is clearly the cessation of the war in a way, which has helped bring down energy prices. But I dare say the more important point is what stability in the rupee, which I think we've not seen in the past nearly 8-9 months since October of last year. So stability of the rupee, the FCNRB measures, the ECB measures, all of this put together, and the tax cut that when I put all of this together, what generally the assessment is that, it's very good for the rupee is going to appreciate. But I feel that's probably just only at the very headline level. How would you want to kind of see the impact of all that's happened, A, on liquidity, domestic system liquidity, B, in terms of inflation, and on BOP? Because all these three things together will finally kind of help us get a handle on, say, the fixed income strategy that we want to probably talk about as well.
No, I think this has implications even for equities in a way,
Absolutely.
Right? Because I think this whole concern that was there, and if I could reverse the order in which you mentioned about liquidity, inflation, and BOP was the primary concern.
The first one, correct.
Right? I think all of us were very worried that we're going to have the third year of BOP deficit. And it appeared like the deficit numbers were much larger than before. So I think this whole dispensation around the FCNRB, the ECB that the RBI has done, I think significantly eases concerns around that. And now I think one is talking about a reasonable BOP surplus in FY27. So I think that's a big dial changer right now.
So from a 3-year deficit, we will be moving to a surplus, and so therefore for the uninitiated, I think a BOP is probably taking into account the current account deficit and the portfolio outflows. So it's at a far higher level vis-a-vis the CAD problem that we had in 2013.
Yeah. Correct. So essentially, you're adding on to your forex reserves
in a way.
Correct. Put it broadly, but yeah. So therefore, I think that is a significant
positive.
Positive. Understandably, this is going to lead to better liquidity in the domestic markets. The RBI would be kind of okay with that. Because I'm sure it is going to be conscious about the fact that we are negotiating, cost push, exogenous factor-led inflation, which is external to us.
Yeah, the energy price.
The energy price related one. Plus, this year we have the El Nino.
True.
And therefore, they'd had to be mindful about the fact that these are cost push factors, which could probably be transient in nature, and therefore may not have a permanent element to them. And this is seen by the fact that your core inflation yet is in the 2% handle, and they would therefore watch that number a lot closer than ever before. Given that the core inflation numbers are very comfortable, it is safe to kind of expect that the RBI would look through some of these pressures that the economy is facing right now. So I think inflation numbers, yes, you could see the headline inflation number tend to perk up, and I think they have also bumped up their estimates for this year. So they're therefore mindful and watchful of that factor. But I think they'll probably choose to look through it. And the other thing that we need to remember there is that in its assessment, the RBI has spoken about an average crude price of $85 to the barrel. Now I think pretty much the whole street is veering around to saying it's probably going to be more like 75.
Yeah, I think as we speak today, we are at about 72. The
Under
cost
72.
of the Indian crude basket.
Yeah. So I think is a significant relief from a monetary policy perspective.
So therefore, you are indicating that probably rate hikes in India may not necessarily happen in the next, say, 2 quarters. Even if the Fed were to do so, probably India has some more leeway before we do some rate action. Is that what you want to believe?
One would like to hope so.
Okay.
See, honestly, thus far the RBI has been, kind of mouthing the official line that local interest rates would be determined by domestic factors purely, right? But that's a line that they've stuck to for quite some time.
And to be fair, they have lived up to it. They haven't touched rates despite the problem on the currency.
Yeah, so I think this year as well they will do that. And there is a view that, and this could very well be the case, and as we've seen that, and which is basically saying that use interest rates to manage the local conditions or negotiate the local conditions. Let the currency respond to global rate policy.